2023, what a year it has been. After a difficult 2022, the Dow Jones Industrial Average notched an all-time high this week, and the S&P 500 is flirting with an all-time high today on the last trading day of the year. Patience has certainly rewarded the long-term investor in 2023. So where does that leave us for 2024? We like the setup going into 2024, and we believe that the stock market will continue to set all-time highs in 2024. But don't expect the same level of returns in 24 that we've seen in 23. We expect inflation, interest rates, and the outlook on the economy to continue to dominate headlines in 2024. Progress on these three fronts will ultimately dictate whether returns come in above or below market expectations.
Interest rates and inflation were top of mind for investors in 2023 and will continue to be going into 2024. This year was a pivotal year for Fed decisions, with 4 rate hikes. We're now at a Fed funds rate of around 5.25% to 5.5%. And the market believes this will be the peak before the Fed starts to cut rates in 2024. The Fed's monetary policy is starting to have its intended consequences on the price of goods and services, with the Fed's favorite inflation barometer, PCE, easing to 3.2% year over year. The Fed's annualized target inflation rate is 2%, and they've been steadfast in stating that they want to see 6 months of tame inflation data to be sure that the disinflationary trend continues. This is one of the reasons why the Fed opted to hold steady on rates during their most recent meeting in December. But if you drill down into the data, you'll notice that on a 6-month basis, core PCE inflation has fallen to just below the Fed's 2% target, prompting the market to rally on the hopes that the Fed will start cutting rates as soon as March. Currently, the market is pricing in 1.5% to 1.75% worth of rate cuts next year. We believe the Fed should be focused on not cutting rates prematurely and ensuring that inflation has in fact been tamed, especially given the resilient job market that has held up the economy during 2023.
Speaking of the job market, the second mandate of the Fed's dual mandate is maximum sustainable employment. And the Fed defines this as an unemployment rate of 4.1% or lower. Now, the most recent November jobs data came in stronger than expected, with non-farm payrolls hitting 199,000 versus expectations of 185,000, and the unemployment rate fell from 3.9% to 3.7%. And on top of that, average hourly earnings are up 4% from a year ago. So it's clear the labor market continues to be the key to keeping the economy afloat in the face of one of the most aggressive interest rate hike cycles in modern history. The stock market, and more recently the bond market, reacted favorably to the increasing probability that the Fed may have in fact stuck a soft landing for the economy. But let's not forget about the role corporate America has played in the economy. Corporations, the companies we invest in on your behalf, have done a remarkable job at navigating a higher inflationary environment this year. This is a great stat that I love to share. S&P 500 earnings per share were up 4.5% in Q3 versus a year ago. Compare this to the pre-earnings season expectations estimating 1.2% decline year over year. So the market clearly underestimated corporate America's ability to navigate a higher inflationary environment.
Looking back at 2023, a couple of themes come to mind. The first theme is the Magnificent Seven. The phrase Mag 7 has become familiar at this point. The Magnificent Seven: Apple, Amazon, Facebook, Google, Microsoft, Nvidia, and Tesla. These 7 giants contributed a whopping 100% to the S&P 500's positive return year-to-date through October, which means simply they kept the stock market afloat for most of the year during very uncertain times, both economically and geopolitically. The second theme is efficiency. The market significantly underestimated corporate management's ability to navigate a higher inflationary environment. In other words, while corporations cannot necessarily control the prices consumers are willing to pay for products or services, they can control the cost to produce their products or services. And they did a stellar job of this in 2023. So where does this lead us as we head into 2024? Looking ahead, we expect the S&P 500 to end 2024 in positive territory, but don't expect the same returns we've seen this year. The bottom-up price target for the S&P 500 in 2024 is 5,200 to 5,400, which is up about 10 to 14% from current levels. 2024 consensus earnings growth is plus 11%, and 2024 consensus revenue growth is plus 5.4%. This implies that the valuation for the market, currently at about 20 times price to earnings multiple, neither expands nor contracts over the next 12 months. We think these projections are reasonable if a few things hold true. 1, the market continues to broaden out and the other 493 stocks in the S&P 500 start contributing to the index's performance. 2, inflation and interest rates continue to decline at a gradual rate. And 3, Treasury yields, particularly the 10-year U.S. Treasury, remain below 4%.
2023 can be summarized as a year that rewarded patient investors. 2022 was difficult, but those that stayed the course in 2023 were rewarded. This graphic is a great illustration of how the 5 best days and worst days in a stock market are ultimately just blips along a broader secular trend. Over the next few months, we expect episodic volatility tied to inflation reports, economic data, interest rate decisions, and of course, Fed commentary. The first quarter of the year tends to have some of the largest price movements, so seasonal trends support our thesis for Q1. With that said, we continue to believe that we are in a long-term secular bull market, and this bull market still has room to run. On behalf of our entire team, thank you for the trust and confidence that you have placed in Evans May Wealth and our group. It is not a responsibility that we take lightly. On behalf of Evans May Wealth and our 11-person team, we wish you and your families a happy, healthy, and prosperous new year.